What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered.
What's up, everybody? Welcome back to another episode of the CPA Zone. I'm your host, Ryan Pulis, and today we're diving into a topic that's crucial for all real estate investors, real estate professional status, also known as REPS, and REPS combined with a cost seg study. So together, REPS and a cost seg are a powerful tax savings combo. So if you think you qualify as a real estate professional, be sure to listen. And if you're not sure, be sure to listen as well, because it's something you want to make sure you get right. So REPS is a tax designation that can save you thousands of dollars, but it's also one of the most scrutinized areas by the IRS. So let's break it down. First, a quick history lesson. Before 1996, real estate investors had it really good. You could easily offset rental losses against any other income, W-2 wages, business profits, you name it. But in 1986, Congress passed the passive activity loss rules, which are found under Section 469 of the Internal Revenue Code. This put a stop to those good old days of using your rental losses to deduct whatever you needed against other income. So rental losses or rental activities became passive by default. Often this is referred to as the per se rule, and that means your rental losses cannot offset non-passive income like your W-2 wages or your active business income. But here's the kicker. At the time, this rule unintentionally penalized real estate professionals who actively managed their own properties. So imagine being a home builder or a full-time landlord and not being able to use your real estate losses against your real estate income. Doesn't seem fair, right? If a doctor, let's say with two separate offices, has a profitable office and then a non-profitable office, they can net the losses against the profits of the other. But real estate professionals for a time were not able to take losses from one part of the real estate business and offset it against other real estate business income. So fast forward to 1994, Congress stepped in again and introduced Section 469C7, creating the real estate professional status, or AKA REPS, as somewhat of a lifeline for those actively engaged in real estate. So let's talk some specifics. To qualify for real estate professional status, you need to clear two hurdles. First, more than half of your working hours in the year must be spent in real estate trades or businesses. Second, you need at least 750 hours per year in real estate activities where you materially participate. Now, if you file a joint return, one spouse needs to clear both these hurdles alone, cannot combine your time. So what exactly counts as real estate activities? So fortunately, the IRS gives us a clear list in the regulations. So the real estate activities they include are development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, and brokerage. But a heads up for brokerage, things like a mortgage broker do not count. They consider that more of a financing activity. But real estate agents, sales agents, do fall under the brokerage category, even if they don't have a broker's license. So the name's a bit misleading. There's some court cases out there. Generally, a real estate agent that is self-employed will be considered to qualify under the brokerage real estate activity. Now, let's say you've cleared those two hurdles. So more than half your time in real property trades or businesses, you've got more than 750 hours of material participation in real property trades or businesses. Congratulations. However, there's another step to make those rental losses truly valuable and ensure that you can deduct them against your other income. You have to demonstrate material participation in your rental activities. So qualifying as a real estate professional, you have to materially participate in the real estate trader business. Now you must also materially participate in your rental activities. Now, maybe your real estate business is managing your rental properties, then many of those hours are going to be basically the same. But if you are a full-time real estate agent, your 750 hours in your real estate agent trader business, that's one set of material participation hours. You must also materially participate in your own rental activities. So hopefully that makes sense. Without material participation, your rental losses remain passive, even if you're a real estate professional, and those passive losses can only offset other passive income. Now, how do you demonstrate material participation? So again, the IRS gives us 7 ways in the regulations. There's 7 different tests, but there's 3 that are really the most commonly used. So 1 is you spend more than 500 hours per year on your rental activities. 2, you do substantially all the work yourself, like handling leases, repairs, tenant management. Substantially is not really defined here, but based on court cases and exams our firm has been through, it basically means everything. Could someone help in a small fashion somewhere? Yes, but you're pretty much doing it all. There's not really a bright line threshold test, but you are doing practically everything yourself. Just aim to hit everything yourself, and you could have a chance at passing this test. Test number 3 would be spend 100 hours and more than any other individual involved in your rental activities. So those are the 3 most common ways to show material participation. Now, unlike the real estate professional status hurdles, your spouses can combine time on a joint return to meet material participation. But I hear you ask maybe, what if I have multiple properties? Do I have to hit these tests for each one individually? And the answer by default is yes. The default standard is you have to materially participate in each rental property to deduct the losses. Now, however, there is a grouping election that allows you to treat all of your rental activities as one. So this group election, called the G election under Treasury Regulation 1.469-9G, lets you treat your entire rental portfolio as a single activity for material participation. You need to be careful though. This election is binding and it impacts your ability to claim losses upon the sale of individual properties. So you need professional guidance here. That's key. Now let's get practical. What hours count and what hours do not count towards real estate professional status? You've got to be involved in the day-to-day operations. Finding tenants, doing repairs, collecting rent, supervising, maintenance, things like that. Doing the maintenance yourself. It has to have a direct impact on the operations. So things that generally do not count as material participation are investor type activities like financial analysis, reading market reports, training and education. They're not going to count. Watching contractors, like not real supervising, that time's not going to fly unless your job is a supervisor in a construction business you own perhaps. Just merely watching contractors not going to cut it. Travel time, not going to cut it. You need to be performing activities that have a material impact on the operations of the business, or in the case of your rentals, your rental properties. Also, it's key to keep meticulous records. Think daily logs, detailed notes, receipts. If you ever find yourself audited in real estate professional status, audits are common. Your documentation is your best defense. There's just no getting around it. Now, if you qualify as a real estate professional and materially participate in the operations of your rentals, congratulations. Now you can really supercharge your deductions by adding in a cost segregation study. So very basic, simple terms, cost seg study breaks your property down into its individual components, like the roof, plumbing, appliances, landscaping. It allows you to depreciate certain parts much faster than the standard 27.5 years for residential property or 39 years for commercial property. So why does that matter? It's because faster depreciation means bigger deductions early on, especially in year 1. Bigger deductions means you're keeping more cash in your pocket instead of sending it to the IRS. So here's an example. Let's just say you buy a $500,000 property, ignoring land for simplicity. Normally, you spread the depreciation out over 27.5 or 39 years, so decades. With a cost seg study, you can reclassify, say, $100,000 of that $500,000 into 5, 7, or 15-year property. That could translate into a massive deduction in year one, especially if you pair it with bonus depreciation, which is now permanently at 100%. Using our example of finding $100,000 from the cost seg study that can be allocated to 5, 7, and 15-year property, that entire amount, the full $100,000, can be deducted in year one using bonus depreciation. And assuming you qualify as a real estate professional, that deduction can offset your other active income, W-2 wages, or your active businesses. Now, even if you've owned the property for a few years, it's not too late. You can still do a cost seg study that looks back and catch up on missed depreciation without amending past returns. Now, the catch is bonus depreciation is going to follow the rules that were in place the date your property is placed in service. So if it was placed in service in 2023, then your bonus depreciation that would be allowed is 80%. If you had a property placed in service in 2022, the last year we had 100% bonus prior to this year, 2025, then you're able to use 100% bonus depreciation. So it really allows you to just take significant deductions in year one using bonus depreciation cost seg study with the real estate professional status. So let's quickly recap. To qualify for real estate professional, you need to spend over half your time and more than 750 hours in real property trades or businesses. 2, you need to materially participate in your rentals to turn those passive losses into active deductions. 3, be sure you keep detailed, credible records. 4, you consider grouping your properties to simplify the material participation requirements. 5, use cost segregation studies to enhance that year one write-off. You can take those tax savings, reinvest into new properties, and let the tax savings that would have otherwise gone to the IRS, use that money to grow your real estate portfolio. Some of the tax plans we will work up with the real estate professionals, we take those tax savings, we do the cost seg, use bonus depreciation, take the tax savings, redeploy that money into a new property, repeat it the next year. And then again, you repeat and eventually you're going to get larger and larger properties. You're going to build out your real estate portfolio much faster than you'd be able to without using these strategies. So real estate professional status really can supercharge your tax savings, but you do have to do it right. So make sure you're working with a knowledgeable CPA that understands this area of the tax code and can navigate these waters safely for you. So that about wraps up today's episode. If you enjoyed this discussion, please make sure you subscribe, leave us a 5-star review, and reach out with any tax questions you have or a topic you would like to hear covered. We are taking on new clients, so if you're interested in our tax advisory services, then book a free discovery call today using the links in our show notes. Until next time, have a great day. Are you interested in becoming a client? Click the discovery meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulicegroup.com/contact. That's ThePulicegroup.com/contact.